6 or 8 months a bit puzzling. I don't know if I could distill a theory of the case. One of my former colleagues, Tim Geithner, used to say a plan beats a plan. Well, beats no plan. Well, they've had plans, and they have different plans. I think a strategy beats all of these plans. It is not obvious what their strategy is. I know, to Scott's point, they say they're data dependent. I don't know exactly what that means.
Have they let the markets dictate too much to them rather than the central bank dictating policy? I
think that point is right. I think they look to me, and I'm try to be as sympathetic as I can. They've got a very hard job. They look to me asset price dependent more than they look data dependent. When the stock market falls like it did in the beginning of this year, they say, oh, we better not do anything. Stock markets are now at career highs. I suspect when they meet over the course of the next 10 days, they will suggest, oh, now they look like they can be somewhat more responsible. I don't like changing policy meeting to meeting based on data or even what the S&P 500 is doing. I like making it based on what's happening to the real side of the economy, and that has not been very convenient over the last 6 or 9 months.
If the whole rationale of QE was to boost asset values to conjure up some animal spirits in the underlying economy, everything they've done has been about asset prices. Going in has been about asset prices. Now trying to get out, it's about asset. It's been asset price, and there's no evidence, really, that they can do anything about the underlying economy, other than hope that it improves based on people feeling better about their houses and their stocks.
So in the darkest day of the crisis, when markets were falling, I must admit, trying to get asset prices up, try to get markets clear in the depths of 2008. Nothing wrong with that.
Right.
We're supposed to respond to financial crises. That was 7 and 8 years ago. This preoccupation with your show and with the Bloomberg screen and with stock prices.
The what?
This is
the Bloomberg screen. Oh, the Bloomberg. You mean those little,
little devices on my phone.
I thought you meant the TV where no one is, I don't think, ever seen that.
So that is not the right worldview for central bankers at a time like this. The right worldview is what's happening the real side of the economy. And the bad news, as Larry Fink, I think, suggested, the bad news is the real side of the economy in the U.S. has deteriorated since September. Quarterly earnings will now be down 6 quarters in a row. That's the first time that's happened outside of a recession. So the Fed had a long window to tighten policy, to raise rates, 2013, 2014, 2015. And it strikes me they missed that wide open window. That's not a good thing.
So you would not be raising rates right now if you were sitting at the table?
So if I were, I wouldn't have raised rates in December. I find it odd that you had a window of 2.5 or 3 years with the supply side of the economy doing better, corporate revenues increasing, profits increasing, an economy that wasn't great, but at least going in the right direction. I would have been much more worried in December than May. But to your point, I don't want to dodge it. What would I do now?
Yeah.
The Fed is sitting on $2.5 trillion of treasuries. There is a scarcity of risk-free assets in the world. There's no good reason, in my judgment, why those should be on the Fed's balance sheet. If I were Chair Yellen and her colleagues, without a lot of headlines, I would say we'll be auctioning these treasuries over to the markets. Here is the fixed schedule. We'll be doing it 3 or 4 months from now, unless there's exigent circumstances the contrary.
They're not even talking about letting this stuff run off now. They're talking about renewing it, and whether that be on short-term or long-term basis. And nobody knows what short-term or long-term is.
So why is that? Why is it that they're so worried about touching the balance sheet? I'm afraid Joe's got this one right. Because they think that balance sheet is what's keeping asset prices.
Why is everyone always afraid to say that I'm right about something? It's like you don't. Larry Fink just said that. Look, okay. Did you finish your thought? Because I want to ask you something.
No, I want to hear the rest
of it. This is about you, not me.
No, go ahead. Finish your thought. You are done.
Yeah.
You have written in some of the pieces that I really like. You have argued that the Fed isn't just not having a positive effect, but you've actually made the case that maybe it's dampening economic activity in the sense that people don't do long-term investment because they can buy back stock, they can do mergers and acquisitions. When do you think we crossed over? You just said you agreed with what the Fed did initially. How long have they been doing things that either are not helpful or actually deleterious? How long has that been going on?
So, too many people, central bankers, has-beens like me, focus on the wrong side of the decimal point. Try to be too precise about exactly when policy should be done.
Right.
We should be focusing on the left side of the decimal point. We don't understand the economy that well.
Okay.
You want to get policy about right. You want to look like you know what you're doing. You want to stay in your lane. Those are good rules for a central bank. I would say the Fed's policies have been running against capital investment, discouraging real investment in property, plant, equipment, and software for several years. And we should not be surprised why there is such a shortfall in capital investment in the economy. And it's not because of Brexit. It's not because of these other things. It's because the incentives for businesses to invest in the real economy aren't very good, which is bad news for workers. Now, all of this is great news if you have a big balance sheet, and Larry Fink spoke to this quite well. If you were trying to design a system to make risk assets go up for the half the country that owns risk assets, this is the optimal policy.